as we host our first international tax webinar. This in particular is going to be exploring the issues around overseas expansion. So my name is Dominic Ball. I'm one of the tax directors here at Pierce. And just briefly, by way of background, I recently joined Pierce in September last year. My experience is primarily in OMB tax. However, I specialize in corporate tax in particular, having worked at Grant Thornton in the large corporate team and PwC's transfer pricing team in Manchester prior to joining Pierce. So turning to our agenda today, we'll be looking at first, why do businesses seek to expand overseas? What are the key issues around overseas expansion? How to determine what's the most appropriate operating structure for how you're looking to expand overseas, and then looking at general trading and profit management issues around a new overseas structure. So firstly, looking at why businesses look to expand overseas. The reasons for doing so vary from business to business, but generally once a business has been successful in its home country, expanding to a new overseas jurisdiction generally allows the business to access new markets with the potential to build new customer bases and generate new revenue. It's often the key driver for businesses in these circumstances is they're looking for further growth, further expansion. Other businesses may look to establish an international business from the outset. This may be to attract international investment from funds in overseas territories. I've got a number of clients who are sort of early stage growth companies. These are VC-backed companies which they have to set up an international structure right from the outset to be able to attract investment in from the US. So the reasons people and businesses choose to do so vary, and the structures then that need to be put in place will vary depending on what businesses are trying to achieve. Just looking at some of these drivers in a bit more detail. Obviously, looking at expanding overseas, as we said, it attracts new revenue potential. It's opening your business up to new customer bases, which should mean more sales, and this can help your business grow by attracting further customers outside your base market. It can also be there can also be a driver to access a larger talent pool, particularly where you might be struggling to attract certain talent within certain sectors. This can be, again, particularly relevant within tech companies. I've seen a number of companies struggle to hire developers and engineering staff, and so I've had to look at setting up global bases to be able to attract developers and engineering staff throughout Europe and Asia. So the reasons why they do perhaps different to others who are perhaps looking for revenue potential, but both present different tax issues which need to be considered. There may also be advantages to an overseas expansion from perhaps looking at simplifying your supply chain, whether you're looking to shore up supply by setting up your own manufacturing operations, your own raw material sourcing, and that may involve moving closer to where you actually source raw material parts, so perhaps setting up in Asia, or for the ability to access lower labor rate markets. Choosing the right market will then vary depending on what it is you're looking to achieve. From a purely sort of revenue growth perspective, you may be looking at one, just focusing on a few select markets and adopting a market concentration model. So perhaps looking at where your products and services perhaps fit more closely to your target customer base. So this may involve picking perhaps sort of countries with commonalities in culture and language, or somewhere where your product's got a significant market edge. And this may involve then just looking at sort of key market territories and exploring how then to expand into those territories. The alternative to this is a more diversified approach, and this is where you look to establish as many markets as possible, trying to attract small market share in various number of territories, but looking to really sort of build on a rapid growth model. Each has their own advantages. Each can work for different types of businesses, but these are the commercial factors that will sort of build into the various decision making right at the start of an overseas expansion process. And then again, looking at how you then take that business forward in the first instance, the early decisions around distribution channels need to be well thought out from the outset, as this will impact again on the appropriate structure and the tax implications later down the line. So this may be that you are actually looking to build out sales team and sales force in other territories. You may be looking to set up distribution networks, warehousing, and storage to help sort of tackle customs issues. These may all be the factors that need to be considered right from the outset. But your approach to taking your business to market in another territory is again something that will feed into the overall approach in terms of how you look to take your business overseas and build on the growth that you've developed in the UK, but with the more complexity of actually adding some additional movement of goods and people around to facilitate the new growth channels that you're looking to put in place. So one of the key issues then that your business is likely to face, and some of the things that need to be considered as you're looking to set up the international expansion. So there are a broad range of tax issues that can arise, and it really depends on the types of business that you're in, the way you're looking to go to market, and the type of structure that you're setting up, how each of these issues will apply. So having a clear thought out plan at the start will help tackle these, and this is where the advice of hiring someone to advise on the various issues really comes into play in being able to talk through how a structure can be set up to fulfill your growth plans and to manage it in a way to avoid double taxation, to ensure that the profits that you're making in overseas territories can be brought back to the UK in an efficient manner without resulting in sort of loss of taxes in the local territory through withholding taxes, and really streamlining your operation so your business can focus on growth and maintaining more of the growth that it generates. So some of the key issues then that will need to be thought out. Firstly, the double tax treaties, and so this is an agreement between two territories which set out taxing rights for businesses operating across borders. So the UK has one of the largest networks of tax treaties with more than 100 countries. The conventions within the tax treaties, as I said, aim to eliminate double taxation of income and gains, and they work by dividing up taxing rights. And so a treaty will set out which country or which territory has specific rights over profits or gains generated in a particular way, and it will set out terms for what constitutes the creation of a permanent establishment, for example, which we'll touch on later. So double tax treaties are an important agreement and something that should be considered right from the outset once you've identified which territories that you're looking to expand into, as this will form the basis of understanding how your overseas expansion is likely to be taxed in the local territory and what the implications could be from your UK tax position as well. Another important aspect is the withholding taxes and local taxes of a particular territory. So in various territories have different local rules. This could be just their general corporate income tax rate, which could be particularly higher than the UK, or it might be lower. And that distinction between the tax rate of the territory which you're going into will depend on the latest structuring of the arrangements between the UK business and your overseas operation, as you want to manage how much profit is generated in the overseas territory, particularly if it's a more higher tax jurisdiction. You don't want to be necessarily setting up a structure which is likely to result in significant overseas tax when it doesn't necessarily need to be the case. And just touching on withholding taxes, just briefly, as we'll look at this later in the webinar, withholding taxes are essentially a tax that applies on the extraction of income, generally through interest, dividends, and royalties from one territory when they're paid to a resident in another territory. So an overseas jurisdiction may charge a withholding tax on the payment of dividends to an overseas parent. So this can particularly erode the profitability of an overseas expansion if you're having to pay significant withholding taxes just to be able to take the profit out of that territory. So if that is the case, and it's key that this is a particular territory that you need to be on, and it has an unfavorable withholding tax position, we may need to look at how you structure the operations so that the business can extract more money through servicing and trade arrangements, which may not fall within the withholding tax rules. And now the transfer pricing implications, again, just briefly on this, is something that we'll cover a bit later on. It's essentially how businesses will interact with each other, and how the services which are provided between two companies within a group are essentially priced for tax purposes. So there's specific rules from tax authorities which set out how arrangements between two entities should be priced. And the overriding principle for this is what's called the arm's length principle. So essentially, transactions between connected parties should occur as if they were occurring between unrelated parties. And these rules apply to financing, the sale of goods, the provision of services, and the return on intangibles such as royalties and license agreements. So it's really wide-ranging rules that will impact, again, the nature of your overseas operations, and something that needs to be planned in, particularly where, again, you're interacting with jurisdictions which may be particularly a high tax jurisdiction. And those are things to consider will be the VAT and local taxes. And this is something that just needs to be planned for in terms of how your business is set up, making sure you have the necessary registrations, and making sure you don't create unnecessary sales tax issues by not considering these at the outset. Staffing is again another key consideration. This will be something that you'll need to think about in terms of whether you're going to second UK staff to help with the initial setup, or are you just looking to employ an overseas base. Both will have local employment tax and social security obligations, and these will need again registration, and will need to form into the planning and budgeting for developing the headcount in whichever jurisdiction you're looking to expand into. And then finally, once you've got to sort of the end of the operations, or at the end of the planning stage, you've been in business in the territory, you've generated a profit. How can you get that profit back to the UK and back to the shareholders of the UK business in the most tax efficient way? Again, that's going to sort of rely on the impact of withholding taxes. It's going to rely upon also the setup of the group structure and how the entities are interacting for transfer pricing purposes. So after noting those issues, the first thing then is to think about, once you've decided what territory you're looking to expand into, having reviewed the double tax arrangements between the UK and the relevant territory, what is then the most appropriate structure for what you're trying to achieve? So there may be something as simple as just looking at a distance selling arrangement, and it's due to sort of the advent of the internet and the web businesses now. You no longer need to be physically present in a country to do business there, and so it may be that your initial overseas expansion is one of a distance selling arrangement, and this can be generally quite easy to set up. It doesn't involve the creation of new businesses, but it can present the issues around VAT and customs obligations, particularly if you're required to register for sales taxes in multiple jurisdictions. If you're looking to distance sell into more than one country, it could sort of present significant VAT obligations for you. It would also be necessary to think about how you sort of overcome the customs position in terms of getting products into particular markets and ensuring that customs aren't sort of levied on the customer, particularly if you're dealing with in a B2C market. That may be sort of good for an initial sort of venture into an overseas market, but the likelihood is that if you really want to sort of grow revenue in an overseas territory, you're going to need some form of physical presence. You're going to need local knowledge. You're going to need local people to help really build revenue within that territory. It may also be necessary to look at how to reduce your supply costs, and again, that may involve the setup of sort of overseas warehousing and manufacturing to be able to reduce transport costs or distribution costs associated with your business. And again, those options then lead to a consideration of an increased presence and whether to then go down and setting up an actual new subsidiary in an overseas territory, or a more informal arrangement of a branch or permanent establishment. So those two entity types, if you're not familiar with them, a subsidiary, again, something that you'll probably be aware of, a separate legal entity. It will be wholly owned subsidiary of your existing UK parent company. A branch, however, something that you might not be aware of is where you don't have a separate legal entity, but you have essentially a taxable presence in another territory. So this could be created inadvertently or intentionally. It could be inadvertently if, for example, you decide to hire sales staff, for example, in a different territory to start negotiating contracts on behalf of the UK company. You can inadvertently create a permanent establishment in the territory in which you employ those people, and therefore create an obligation to pay some element of corporate income tax in the country in which that permanent establishment was created. It could be done as an intentional structure, so you may go into a territory knowing that these actions are going to create a permanent establishment, so that you will formally register that from the outset. A branch or permanent establishment can generally be easier, particularly on the continent, set up than a company. It doesn't have particular capital requirements. It's just sort of an extension of the parent company business. It's not a separate entity that needs its own capital. It needs its own shareholders. It's got the same sort of legal structure and policies of the parent. So there's no requirement to sort of roll out additional governance costs and governance procedures when setting up a branch. So it can be quite easier. The downside is that there may be lack of sort of credibility associated with that. It may be difficult to sort of obtain overseas banking arrangements if you only have a branch presence rather than a limited company. Some customers or suppliers may not enter into contracts with overseas companies, so that may again lead you to needing a more formal presence of a separate limited company. But again, these are the commercial things that will need to be considered before looking at then what are the tax consequences. So then just touching on a branch then in more detail. So generally a UK tax resident company is subject to UK corporation tax on its worldwide income and gains. So this means that if you have a UK company that's in the US, Asia, or into Europe, and it's doing business in that territory, you're sending people into that territory to enter into contracts. You set up an office there, you set up a factory in a different territory. All that income forms part of the UK company's income and will be subject to UK corporation tax. As I mentioned, those activities of sort of setting up offices and factories and putting people into different territories can lead to the intentional or unintentional creation of a permanent establishment. So that generally within a double tax treaty, they set out two typical definitions of what will create a permanent establishment. That is a fixed place of business. So that is where you establish an office, a factory, basically a place of doing business, and you do business in that place. Or there's an alternative one, is a dependent agent, where you don't necessarily have a fixed place of business. You may just have staff that work remotely. But if they are habitually concluding contracts on behalf of the UK company in a different territory, they may then create a permanent establishment of the UK company in that territory, which then gives the obligation to pay some form of corporate income tax in that territory. From the UK perspective, there should be relief from double taxation of the element that's taxed in the other territory. This may be done through allowing of a credit against the UK tax. So essentially, if you pay tax in another territory, the amount of tax that you pay can then be offset against the tax that would be due on the same profits in the UK company. So you won't be essentially being taxed twice. You just be subject to tax at the higher rate. So if the tax rate in the UK 19% and the tax rate in another territory was, say, 25%, the most tax you would pay on those profits that were derived from the activity of the permanent establishment would then be 25%. If it was the other way around and it was lower, you would only get a credit for that lower amount of tax. So you'd still pay the 19% UK corporation tax on those profits. Another alternative is to make an election in which you can exempt the profits of the permanent establishment in the UK altogether. That applies then to all permanent establishments created by that company. So it's one to consider and not one to enter into lightly, because once you've made it, it then applies, irrespective of whether that permanent establishment is profitable or loss-making. Because one of the key advantages of a permanent establishment over a subsidiary is that the UK company can then get relief for any losses derived from the activities of the permanent establishment, as it'll be able to offset the costs against its own income from the UK. However, if you make an election to exempt profits and then the PE becomes loss-making, you will then not be able to get relief for those losses in the future. So that election needs to be considered sort of in light of the future direction of the business, and also whether it's likely to create, whether you're likely to create multiple PEs going forward, in which case you may want some to be exempt if they're profit making and some to be unexempt if they are loss making. And again, that will need some structuring consideration into how to set that up effectively, so you can make sure you're getting the best of both positions. Then the alternative structure, then comparing the two, if you then look at how the subsidiary arrangement would work, instead of just having people and operations in different territories, you actually then create separate subsidiaries in each of the territories in which you operate. Now, but each of those subsidiaries will be subject to local tax in the relevant territory in which it sets up, and it shouldn't be subject to UK tax unless it becomes UK tax resident. And generally, an overseas subsidiary would only become UK tax resident if it was seen to be centrally managed and controlled from the UK. And that would be if, for example, the directors of the relevant subsidiaries were based in the UK, never actually went to the territories for board meetings. They made all the key decisions in relation to the subsidiary in the UK. Then in that scenario, you could create the situation where, for example, a US subsidiary is actually UK tax resident, even though it's incorporated in the US, because of where the central management and control has been undertaken from. So that will need to form into the decision-making process in, if you are looking to set up overseas subsidiaries, how will they actually be managed? And do you have the resources available to dedicate sort of senior management time to be able to go over to the relevant territories, actually hold board meetings, and ratify and consider the key decisions of that company in the territory and not in the UK. The other scenario as well, where the UK could be subject to tax on a subsidiary, is if it falls within some of the anti-avoidance provisions. Notably, this includes the controlled foreign companies rules. and that particularly applies where you've got a subsidiary in a low tax jurisdiction. So it's aiming to avoid, it's aiming to tackle the avoidance arrangements whereby a company would set up a subsidiary in a low tax jurisdiction and basically try and get profits into that subsidiary rather than the UK. In that situation, the CFT rules may apply, in which case it would essentially unravel that and subject to tax in the UK the profits of that subsidiary in the low tax jurisdiction. And then with that setup that you have here, you will then need to consider how each of those subsidiaries will interact with the UK parent and what the nature of those interactions will be. What services is that subsidiary providing to the UK parent, and how should any transfer pricing arrangements be dealt with between the various subsidiaries. We'll touch on that in a bit more detail later on. Then, just as a brief summary, then comparing the two methods of an overseas expansion in terms of entity choice. A branch is an extension of the company in which is operating in the territory, compared to a subsidiary which is a separate, distinct legal entity. The profits of a branch are included in the UK taxable profits, whereas the profits of a subsidiary are not included in the UK corporation tax. The losses of a branch will be available to offset against the profits of the UK company under a branch, but that won't be the case with a subsidiary. And again, the main distinctions from a commercial perspective and a more operational perspective is the simplicity of a branch in terms of its ability to just maintain one set of financial statements with the parent company. It can be more easily closed down if it's unsuccessful. However, a branch, because it isn't a distinct separate entity, the parent will remain liable for the branch's operations. So again, if you're going into a particularly litigious country, it may be that you want to set up a separate legal entity to provide that protection to the parent and not put at risk the assets of the parent if it's likely that the operations in the other territory could result in exposing the group to risk of litigation or claims against the company. So moving on now to some of the more the operational matters and the more day-to-day trading arrangements. Once you've decided on which structure you're going to implement, whether it's the branch or a subsidiary, you'll need to consider the hiring of employees, as the main purpose of the expansion and actually creating a physical presence is generally due to the establishment of an overseas team, whether that's a sales team or procurement team, whatever the purpose of the expansion was. It's likely that people will be needed on the ground. And a business has two ways in which it could look to get those people on the ground. It could use its own existing employees and second them overseas, subject to them that be willing to do so. Or you could be looking at employing overseas people with local knowledge and gaining sort of local contacts and networks. Each has the pros and cons, but both will require local social security registration and consideration of local employment rules and additional employer obligations such as pensions and benefits that may need to be provided if employing people within that territory. You will also need to consider from a UK perspective, if you're seconding employees overseas, whether you need to consider tax equalization arrangements, particularly if the jurisdiction is sort of a higher tax jurisdiction from an employee perspective. You'll need to then consider how you sort of equalize their salary so that they are no better or worse off. You will also need to consider, depending on the length of the secondment arrangement, what impact that will have on UK national insurance, as they may continue to be obliged to pay UK national insurance if it's a more short-term secondment. So these factors will need to be considered as part of that arrangement. With hiring overseas employees, you obviously need to consider how you're going to sort of embed them into the team, how you can set the team up for success in integrating with the existing business. How can you ensure a good cultural fit between the overseas team and the UK team? And that will all need to be sort of brought into the onboard planning. And why it may be that you need a mix of both UK staff seconded, at least at the outset, and a local team to be there to undertake the long-term day-to-day operations going forward. And moving on to the transfer pricing aspect, this is all sort of then dependent on the structure that you set up and the people that you're employing. As transfer pricing is essentially the pricing in which related companies should interact with each other for tax purposes. The rules apply to the provision of goods, so you might be selling products from one subsidiary to another. It could be for the provision of services. It might be that the UK parent is providing management services to a subsidiary, or you might have a subsidiary that's providing a particular service to the UK, for example, call centre services, customer support, procurement. All these arrangements then need to be considered and priced accordingly for tax purposes in line with the arm's length principle. And the arm's length principle is what's sort of considered generally by most jurisdictions under the OECD guidelines as the basis in which related parties should transact. The reason why these rules are in place is essentially to avoid multinational entities being able to distort the level of profit, so the level of tax they're paying by altering the profits in different territories to give an outcome where essentially the profits are not aligned to the creation of value. And so this is essentially put in place to tackle the arrangements where if you had, say, a subsidiary in a low tax jurisdiction and you wanted to put loads of profit into there and take it conversely out of a higher tax jurisdiction, you may look to charge sort of management services, for example, or a higher cost for the provision of goods so that it makes more money in that territory. If that price isn't in line with the arm's length principle, then for tax purposes, the arrangement would need to be corrected, whether you've accounted for it in this way or not. The tax treatment will need to follow the transfer pricing rules. And these rules apply to UK entities, and it will apply between UK to UK entities in theory as well. However, HMRC are not particularly likely to look at UK to UK transfer pricing arrangements on the basis that the loss to tax is going to be non-existent unless there was some particular way in which you were accessing losses which you otherwise wouldn't be able to do. From a UK perspective, there are exemptions for small and medium-sized entities. So a small entity is classed as those with less than 50 employees, in which case the UK transfer pricing rules don't apply to a company of that size. A medium-sized entity is one that has less than 250 employees. And again, they're exempt from the transfer pricing rules. However, HMRC can issue a notice to a medium-sized entity and require them to calculate their corporation tax as if the transfer pricing rules would apply, which means that essentially if your transfer pricing arrangements was not providing sort of an arm's length outcome in that you were the arrangements were diverting profit out of the UK and into a low tax jurisdiction, and you were a medium-sized entity, even though we have an SME exemption, HMRC could still write to the company and require them to correct the tax returns and apply the transfer pricing rules. So generally sort of recommended that even if you are a medium-sized entity and you have employees of more than 50, you do follow and apply the transfer pricing rules so that there isn't sort of a risk of double taxation if there is a later notice given to the company by HMRC to apply the transfer pricing rules and correct any position later down the line. So the medium-sized entities are in a sort of grey area where if they're not applying the transfer pricing rules, they are leaving themselves open to potential risk in the future of a loss through double tax, because it would result in a sort of a unilateral correction of the UK tax position without necessarily giving a corresponding adjustment into the overseas territory in which you had already declared tax. Now, the determination of the transfer pricing policies and the transfer pricing for various intercompany transactions will depend upon the overall operating structure of the group. And fundamentally, this is down to what's called a functional analysis. So the starting point of any sort of transfer pricing exercise is to understand what each entity is doing and understand essentially the functions it performs, the assets used, and the risks assumed by each party. And it's once you've got that understanding, it's then those activities which you would compare to an external comparable data that would give the indication of what an appropriate profit margin would be based on those level of activities and risks assumed. Now, what this means is then that as part of your structuring of an overseas expansion and how you set up your overseas group, you then have some discretion in terms of what functions you put into each subsidiary and what risks it assumes. And this therefore gives rise to planning and opportunities in terms of if you are entering into a high tax jurisdiction, then making sure that the operations which you're putting into that high tax jurisdiction are not particularly high value, or they are sort of not high risk taking. So if you limit the risk of a subsidiary operating in a high tax jurisdiction, it is then under the transfer price rules entitled to a lower return. But the key to this is substance. So you'll need to actually have the underlying functional profile of each entity understood to be able to determine what the categorization of each entity is, and therefore how much tax it should pay based on the level of profitability in each subsidiary. Now, I'll just sort of evidence that sort of a bit further by way of an example. If you were looking to set up, say, a manufacturing entity in Asia, for example, it might be particularly high tax territory. You have the option in terms of how you would establish that manufacturing entity. For example, it could be a fully fledged manufacturer, and this would be essentially akin to an ordinary manufacturer that operates with third parties. It would have its own QC, QA procedures. It would be responsible for new product R&D. It would have its own manufacturing planning team. It would be responsible for sourcing raw materials, and then ultimately the manufacturing, assembly, and packaging of the product. Now, within those activities, it would also be responsible for holding inventory. So it would carry the inventory risk, the risk of obsolescence of stock, the risk of damage to stock. It would be exposed to market risk as it would be producing products not to order. So it would bear the risk of perhaps incurring costs in the production of goods which then don't sell. And it would also hold the warranty risk associated with those products. So it would be reliable for dealing with any defects and recalls. All that as a profile of an entity obviously carries higher risk and therefore a higher entitlement to profit. Whereas if you look sort of to the other side then of a toll manufacturer, a toll manufacturer is one that essentially manufactures to order, and it does so using the inventory of the ordering company. So in this arrangement, you'd have your principal company, perhaps in the US, perhaps in the UK, would purchase the relevant raw materials from a supplier. It would direct them to be sent to your toll manufacturer in the relevant territory. That toll manufacturer would produce the goods to the requisite order of the UK principal. It would then package them and send them on to the UK principal for warehousing. Now, in that scenario, it's carrying a lot less risk. It's not responsible for the inventory. It's adding a lot less value to the supply chain because it's literally just processing on command. And as a result, that activity is a lot lower in terms of value adding to the supply chain, and it's therefore entitled to a lower profit. So in this arrangement, then, if you've got a high tax jurisdiction where you're looking to set up a manufacturing entity, putting in place an arrangement or setting it up as a toll manufacturer will help you manage your overall effective tax rate by not putting unnecessary profits then into that particular territory, as more of the profits would then be attributed to the UK principal, which would be responsible for the inventory risk. It'd be responsible for the procurement, it'd be responsible for the planning of new products and development, and all those processes, which then is the value that's attributed to the UK rather than the overseas territory. And somewhere in the middle, you have a contract manufacturer, which essentially is like a toll manufacturer in that it will produce goods to order, but it may be responsible for its own sourcing of raw materials. So it may bear a little bit more risk than a toll manufacturer, but again, nowhere near the level of risk and entitlement to profit as a fully fledged manufacturer. Again, the similar approach can be taken to sales entities. So it may be that you're looking to expand into another territory purely for distribution and revenue generation, in which case you may be looking to put in place sort of a sales team, and how you go to market in that business, again, can differ depending on whether it's going to be a fully fledged distributor or a more simple arrangement in which you have an overseas commission agent. So if you look to, again, you're going into a high tax jurisdiction, you would probably want to set up more on a commission agent basis, where you just simply have a sales team responsible for customer relationships and marketing, and it would essentially send any invoices and agreements back to the UK principal for approval, and the UK principal would then enter into the sale with the third party. Somewhere in the middle, you have, again, a limited risk distributor, which again, unlike a commission agent, it would actually enter into sales in its own name. It will be responsible for marketing on the ground in that territory, but it's not going to be it's not going to be holding inventory, as any goods that it sells will come from, it would essentially just hold flash title. So immediately as it makes the sale to a third party, it would then immediately acquire the products in which it's selling from its related party, which might be the UK principal, it might be one of the contract manufacturers in the group, and it would essentially just create take flash title to the products immediately before the sale. So it wouldn't actually hold any goods in its own name, and so it's not carrying the same inventory risk. But it would be creating sales in its own name, which might be sort of unavoidable, because you may actually want the entity in a particular jurisdiction to have that front-facing role with third-party customers. So typically, limited risk distributors is quite a common arrangement for overseas sales expansion, and it gives you the ability to control the level of profitability being created by that entity, by not giving it sort of a fully fledged distributor status of being responsible for the whole sales supply chain, right from procurement, branding, holding of stock. It's a lot more simpler arrangement, and therefore entitled to a lot lower return. So it's a sort of, to summarize and bring that together, this is essentially what you would look to implement to create that sort of tax efficient structure, is the breaking down of the supply chain into the different components within the various territories in which you're operating, and segmenting the risks outside of the various territories and centralizing them in the UK. So the advantage of this is it gives more certainty over the returns that should be due in the relevant territories. Because it's forming a more simplistic function, it's easier to determine what the transfer price would be for a simpler toll manufacturer than it is for a more complex manufacturer that might have IP, it might be responsible for product development, it might be doing a lot more technical things, in which case the amount of profit it should get is potentially a lot higher, and then potentially subject to more scrutiny by the local tax authorities. The more simpler you can make the arrangements in your overseas territories, the more streamlined the operation will be, and you then sort of centralize the tax position within the main principal, whether that's sort of your UK parent company. So most of the profits then from the supply chain would flow out of the various service providers in the different companies around the group back to the UK principal. So if you start from the beginning of the supply chain, the UK principal would be responsible in this situation for the procurement of raw materials. It would identify the relevant suppliers, it would negotiate the contracts, and it would enter an agreement to purchase them. But it would direct that those raw materials are sent to its toll manufacturer, who may be based in Asia, for example. A toll manufacturer would then process those manufactured products to the specification of the principal, and it would send them to the warehousing. The warehousing could be just in the principal's home country, or it could be in a separate warehousing company in another jurisdiction. So you might have a warehousing centre in Europe, for example, which then sells products on to be held for onward distribution. The principal will then, depend on the arrangements, it may enter into contracts with customers in its own name through a commission agent. So you may have commission agents around Europe, which then basically go and source sales for the principal to enter into, and the goods would then flow from the warehousing to the end customers, with the commission agent just returning a small commission for its generation of the sale, and the majority of the profit then being sat with the principal for taking more of the risk in the supply chain. Similarly, the limited risk distributor model would again enter into contracts with third-party customers, but it would do so in its own name and purchase the goods for onward sale direct from the warehousing company or the principal as appropriate. In that scenario, again, the return that it would be allocated would be a lot lower because it's carrying a lot less risk. Then finally, you just have the other entities. You may have a call center in a separate jurisdiction, and your warehousing, as mentioned previously, which would just charge for the service provision in which it's provided to the principal. So this may just be on a simple cost plus arrangement, giving sort of a relatively small profit in the territory in which the call center is located. So you see, by breaking down the various stages of the supply chain into the different components, you're then able to manage the tax rate across the global operations by ensuring that you're not putting unnecessary value into high tax jurisdictions where it doesn't necessarily need to be, if it's capable of centralizing those decisions and those functions within a principal model. Now, looking then onto withholding taxes, so you may be thinking, well, if we've set the transfer pricing policy correctly, we've moved all the profit back to the UK, so where does the withholding tax fit in? But if we just flick back to this, you'll see that each of those entities around the group will be entitled to a small return. We've managed the arrangement through the transfer pricing to minimize the profits that's being created by the toll manufacturer, the limited risk distributor, and the commission agent, but they're still making some level of profit, albeit small. So then how do we go about just remitting the last amount of profit out of those companies back to the principal? So this may be through through dividends, in which case there could be withholding taxes to consider. So that would just need to be considered in terms of whether the territory in which you're operating in has a particularly aggressive withholding tax regime. You may want to then look at whether we further sort of consider the structure, whether we consider how it was financed from the start, by if for example putting debt into the company would allow a return of that profit through interest, which might have a more favourable withholding tax regime than dividends. Or it may be something that just due to the territory in which you're operating, it is a commercially critical location for the business, and there may just be just an element of withholding tax to accept. But it would just need to be considered right from the outset to see what the implications were. And again, this would really come into point if you had an aggressive withholding tax policy. You really don't want to then be putting in place a structure where you've got high value functions going into that territory, resulting then in more profit being left into that company because of the high value nature of the services it's performing, and then a secondary tax on those profits once you pay the dividends out to the parent company. So it would form part of the initial planning in terms of the setup and the appropriate structure of your overseas operation if you were faced with a high withholding tax territory in which you needed to deal with. And then looking at then the financing of the overseas expansion, this will then need to play out in terms of how do you deal with the initial costs of setup. Will this be sort of an equity financing? You just essentially get share capital in exchange for the initial funds, or are you going to put this in as debt? Both are potential options. Debt tends to be the more flexible approach, given that you're able to then repay the debt quite easily without having to do a reduction of capital or changes to the capital model. But it may be that given the territory in which you're looking to expand into, the subsidiary may have some minimum capital thresholds, in which case a certain level of equity does need to be put in, and that may be sufficient to cover the initial setup costs, depending on what level of capital is required and the extent of the operations you're looking to establish. If that's not the case and debt financing is required, this again could be put in from the parent company. It could be on an interest-free basis, or it could be on interest-bearing terms. Again, it may be advantageous to use an interest rate mechanism to extract more profit out of a particular territory. But again, financing is a transaction which is governed by transfer pricing principles. So the rate of interest in which you charge the relevant subsidiary needs to be on an arm's length basis, and the amount of debt can't result in the subsidiary being thinly capitalized. And by that I mean it's got the level of debt that's been put into the company is supportable again on an arm's length basis, in that if you went to a third-party bank, what level of debt would they provide to the company, and are you providing the same amount? If a bank would only lend 100,000 and you put in 3 million, then the other 2.9 million is then going to be seen as sort of an excessive loan given akin to equity. And so the element of interest on that 2.9 million would then be disallowable for tax purposes, depending on the transfer pricing rules of the country in which the subsidiary operates. So it's not always sort of clear cut whether debt financing is going to be more beneficial from a tax perspective, but it's certainly more easier to deal with in terms of moving money into a country and moving money out. In terms of the repayment of debt tends to be a lot easier to manage than the reduction of capital with equity financing. Now, as I mentioned at the start, there's just anti-avoidance measures to be mindful of, just in case that throughout this you're considering the ability to mitigate UK corporation tax by using subsidiaries in low tax jurisdictions. As mentioned before, the Controlled Foreign Company Rule, CFC, is an anti-avoidance measure that aims to tackle that sort of abuse of essentially moving profits that should be attributable to the UK into a low tax subsidiary. There are a number of exemptions, such as a low profit exemption. So if the profits are not more than 50,000 or not more than 500,000, where non-trading income is no more than 50,000. Low profit margin exemption is where the accounting profits are less than 10% of operating expenditure, or it may just be excluded by the excluded territories exemption. So there are a number of territories which just are excluded from the CFC rules. They're just written into legislation. And the other sort of common get out from the CFC rules is the high tax exemption. So if the local tax paid is at least 75% of the UK corporation tax rate, then it's not going to, the CFC rules won't apply. So for most subsidiaries around the world in sort of established economies where they have a sort of a normal level of corporation tax between sort of 15–19%, you're not going to you may not sort of fall within the CFC rules in that case, but it's more to try and tackle the arrangements where you've got zero or low tax jurisdictions, in which case you're moving profits within those subsidiaries. So just then to summarise what's been sort of a whirlwind tour of an overseas expansion discussion. Firstly, choosing the correct entity structure is key. It needs to be aligned to what the business activities are that you're undertaking, and this needs to reflect the functions which is going to be performed in the territory. So having consideration of whether a branch or a subsidiary is going to be right for business, depending on what it is that you're likely to be doing. If you're likely to be setting up a factory overseas, you're going to be employing staff, you're going to be sort of setting up more riskier activities, and maybe you want the legal protection of a separate legal entity, so you're not putting the UK structure at risk from the overseas expansion, in which case the subsidiary may be the preferred route. However, if it's just sort of an initial venture, you're unsure whether the venture is going to be successful, you might be incurring significant costs at the outset. A branch may be a simpler way to go and may give you the ability to at least offset the initial costs against the UK corporation tax. When considering staff, making sure that you thought through sort of the oversight and control of an overseas workforce. Are you going to be moving UK people into the business overseas so that they can oversee the team and instill the UK culture? And also just bear in mind the local social security and employment taxes that will be required in the relevant registrations. Again, looking at then designing the operating model as we sort of had a discussion around the setting of intercompany arrangements, considering the impact of various function asset risks in terms of the activities of each of the subsidiaries. So it will be important to really have a clear idea of what the tax profile of the jurisdiction is that you're going into, and how best to structure those arrangements from a transfer pricing perspective to ensure the most appropriate outcome. And then finally looking at the financing in terms of what's the appropriate method of funding the initial expansion, whether that's through debt or equity. So I'd like to thank you for joining today, and if you do have any questions, put them in the chat box or unmute and send, and feel free to direct a question to me if you have anything you want to discuss now. Okay, so if there's no questions, thank you for joining us today. And if there is any follow-up that you'd like to discuss at a later date, my details are now on screen, so please do reach out if you do want to get in touch in the future. Thank you very much. I will see you again next time.